All right, so here we go with chapter 7, and chapter 7 is going to be in two parts. So this is going to be part 1. And then part 2 is in a separate video, and the slides are in just a slightly separate or a slightly different format, okay? So chapter 7 is all about investments, all right? And there are a couple of things that we have to remember about investments. Ooh, I need to label this because I don't have a front slide on this. Sorry about that. All right. So let's talk about a couple of basic things, okay? So remember, so I'm going to slide this way now. All right. So before tax rate of return on your investment, this is typically that's typically the information that we're given. But this is typically what we need in order to evaluate things, right? So you need to remember that we can always convert from pre-tax to after-tax, all right? We've already used that formula quite a lot, but that can be really, really helpful, okay? Then there are a couple of things that we have to remember about what determines our after-tax rate, okay? So obviously there's timing, right? When is the income taxed, all right? And then the rate at which the income is taxed, okay? And this rate, all right, depending on the type of income, and what I should say, this depends on the character of the income, okay? And so from a character perspective, is it ordinary or is it capital, okay? And then the other thing that we need to discuss is portfolio investments versus passive investments, okay? And part 2 of the Chapter 7 PowerPoint is going to deal with passive investments quite a lot. So what we're going to focus mainly on right now is portfolio investments, okay? And so portfolio investments, and I'm going to change color really quickly here. Portfolio investments are things like stocks and bonds. All right, so let's list some different types of portfolio income. Okay, so good examples of portfolio income: dividends, interest, royalties, annuities, capital gains. Okay, these are all things that are considered portfolio. Okay, and so their losses, you can't recognize losses until that investment is sold. Okay, now I'm going to slide a little bit over. Okay, and let's talk just briefly about passive. Okay, so passive investments They generate operating income and operating losses. All right. Okay. Now, the losses, let's focus on the losses. Well, operating income, always taxed. Okay. Passive losses generally, okay, are subject to limitations, and they're generally speaking only deductible to the extent of passive income. All right, so we'll talk more about passive income and losses in part 2, but I wanted to talk about it generally there. Okay, so let's move on to some portfolio topics. All right, so interest and dividends. Okay, interest and dividends typically taxable when received. Obviously, a notable exception to this is municipal bond interest. That is not taxable, right? So we're talking about different sources of interest here, okay? And this is important to kind of keep separate in your mind, okay? Municipal bonds, all right? Not taxed at the federal level, okay? Interest from U.S. Treasury bonds are not taxable by states, but they are taxable at the federal level, okay? And then if you get a dividend on a stock, these are typically taxed at preferential capital gains rates, and we'll talk more about capital gains as we go forward. Okay? So that was interest. Let's talk about dividends. Okay? You're going to see in problems things called qualified dividends, and that's certainly going to be an item on your tax return project that'll talk about qualified dividends. Okay? In order for a dividend to be qualified, it must be a dividend that's paid by a domestic, mostly a domestic company, but certain foreign corporations, and that it has to be held for a certain period of time. Okay, and so let's talk about that period of time a little bit. So I'm going to slide over. Okay, so in order for the dividend to be qualified, okay, the stock has to be held for more than 60 days during the 121-day period. Whoops. Okay, that begins 60 days before the ex-dividend date. Okay. I'm going to slide over just a little bit more. Okay. All right. So, and then here we've got this list of kind of preferential rates. Okay. And so qualified dividends are subject to preferential rates. Those are the same rates as long-term capital gains. Typically, all right, most people fall into this 15% preferential rate, but 0 is the lowest, 20 is the highest, okay? And then non-qualified dividends are just taxed like ordinary income. So those would go into the standard progressive tax rate schedule. Okay. So what about gains and losses? Again, when we're talking about portfolio income. Okay. So if things are held for appreciation, meaning not sold. Okay. Gains are deferred, generally taxed at preferential rates when they're sold. Okay. And then there are some special loss rules, and we'll talk about those loss rules. Now, this generally taxed at preferential rates. Okay, let's talk about, sorry for moving that around so much. Long term means more than 1 year. So what does that mean? That means 12 months plus 1 day. So if you held that thing 12 months and a day, that is a long-term asset. If you did not hold it for 12 months and a day, it is a short-term asset. Okay, and why that matters is short-term equals ordinary rates, long-term may equal preferential rates. Okay, so that day can be a very important tax event. Okay, so let's talk about what capital assets are. And we've talked about this a little bit. Capital assets are not defined by what they are defined by what they are not. So a capital asset is any asset that is not used in a trade or business, an account or notes receivable, or inventory. Okay? Typically, if it's called a capital asset, it's going to generate capital gain or a capital loss. Okay? And here you've got your definition of long term and your definition of short term. Okay? Let's talk now about specific identification versus FIFO. All right, so when you are selling capital assets, it is assumed that all sales occur based on a FIFO principle, first in, first out, unless you specify, and then you can sell based on specific identification. Okay, and that's very important because when you buy stocks, let's use stocks as the example, depending on when you purchase them, your basis might be different, right? And so it might be much better for you to sell things with a higher basis, all right? And those might be things that you purchased later, all right? So if you do not specify, it is assumed that you are going to use FIFO. Otherwise, you'll use specific identification. Okay, you can choose. I should make that very clear. You can choose to use specific identification. Sorry, I'm having trouble talking evidently. But the assumption, the default is a FIFO methodology. All right, let's talk about capital gains more specifically. All right, so not all types of capital gains are taxed the same. All right, so we have two. So you have general rules for net capital gains. And when we talk about net capital gains, this is long-term capital gains in excess of short-term capital losses. And there's a whole netting process that we will go over for capital gains. And then you have two kind of special capital gains types and rates, okay? This is unrecaptured. This is Section 1250 gain from the sale of depreciable real estate, all right? It's taxed at a maximum rate of 25%. And then you have long-term capital gains from collectibles and qualified small business stock are taxed at a maximum rate of 28%, all right? We will talk about depreciation recapture when we get to depreciation, all right? So it's just important to know that not all capital gains are created equal. There are different types. All right, we have talked about this previously when we're talking about capital losses. And so these are net capital losses, either short or long term. So if at the end of your netting process you end up with a capital loss, either short term or long term, you're allowed to deduct up to $3,000, okay, for AGI. All right, so I'm gonna change colors on my pen here. For AGI, okay? And so remember that there are three types of 4 AGI deductions: directly related to business income, indirectly related to business income, and then some things that are specifically subsidized by Congress, okay? So this capital loss, right, these would be indirectly related to business income, or you could consider it, honestly, subsidized as special activity subsidized by Congress, because they are subsidizing people investing in the capital markets, and having people investing in the secondary capital market is a good thing for the economy. All right, so this slide and the next slide outline the capital gain and loss netting process, okay? And so this is directly out of your textbook, all right? And so you've got these steps, all right? And so it kind of makes sense, but you're going to combine all of your short-term capital losses and capital gains, okay, including any carry forward, all right? And then you're going to combine all of your long-term items. So put all your short-term items in one bucket, put all your long-term items in another bucket, okay? And then you're going to combine the net result of steps 1 and step 2, okay? Now I'm going to move to the next slide, and then here in 2 more slides we'll do an example, and you'll see how this netting process works, all right? And so then you've got these 4 possible outcomes, okay? All right, so let's do an example, okay? All right, so here we go. So this example is also in the student version, and I believe the solution is in the student version as well, but I'm going to work it out step by step. So I'm going to move this over and kind of put it up in the corner here. All right. All right, so step 1 says combine all your short-term items, right, together. Okay, those are our short-term items. And then we're also going to combine all of our long-term items, okay? So let's figure out what the result of our short-term items are, Okay, so we had a short-term capital gain and a short-term capital loss. So when we net those out together, we have a short-term capital gain of $5,000. Okay, and so now we have to look at our long-term items, and we have a long-term capital gain of $3,000 and a long-term capital loss of $12,000. So what we're going to have then is a net long-term capital loss of $9,000. Okay, so now what do we have to do? Well, now we have to combine those things because they're different signs. Okay, and so we're going to combine those things. All right, and because our long-term loss is larger than our short-term gain, okay, we are going to end up with a net long-term capital loss of $4,000. Okay? Now, so what is the amount and character of Ferdinand's gain or losses for the year? Okay? So the amount is a $4,000 loss. The character is long-term capital loss. Okay? And that's very important that we remember that that's long-term, and I'll explain why. So now, what happens with this long-term capital loss? All right? So we figured out we have a long-term capital loss. So what? All right, well, what happens to this long-term capital loss is actually two different things. All right, remember that we can deduct $3,000 of capital losses for AGI deduction. Okay, now I'm going to slide this over a little bit. Now, so that's $3,000 of our $4,000 loss. This other $1,000 is a long-term capital loss carry forward, all right? It is going to get carried forward to the next year so that it then gets put in the netting process for next year. Okay, and it will remain a long-term capital loss when it gets carried forward. So he just starts out next year with a long-term capital loss carried forward from the previous year. Okay, all right, so we've already talked about some of these limitations. All right, so but let's talk about personal use assets. Okay, so say you sell your car, all right, and for some reason, magic, you sell your car at a gain, all right, and you've had this car for more than a year and a day, then that gain is going to be taxable as a capital gain. All right, now alternately and more likely, if you sell your car, you're going to sell it for less than you bought it for. All right, and that would be a capital loss. But as long as it was a personal use asset, so if you're not running your own business and using your car as part of your business, if you're just driving your kids and yourself around in your car, it is a personal use asset, those losses are not deductible. Okay, you cannot deduct the losses related to personal use assets. Okay, as well as if you have a capital loss as a result of selling something to a related person. Okay. All right, so let's talk about the wash sale rules, okay? and then we'll do an example. All right, so this is verbiage straight out of your textbook, and we'll do an example to kind of show you how this works next. But the wash sale rule, okay, that's what this is called, the wash sale rule, disallows the loss on stock sold if the taxpayer purchases the same or substantially identical stock within a 61-day period centered on the date of sale. Okay, so you've got the date of the sale, and you got 30 days before and 30 days after. Okay, so this is meant to make sure that you can't sell a stock at a loss one day and then buy that stock back, right? Because now you would be benefiting from a whole bunch of losses on the same stock potentially if you bought it and resold it and bought it and resold it and bought it and resold it. Okay, so let's do an example and we'll see how this works from a mechanics perspective. Okay, so we've got Kim, and Kim owns 10 shares of Tower Inc. stock, and her basis is $40 a share. Okay, on December 5th, she acquires 10 more shares at $30 a share. Okay, on December 31st, she sells her original 10 shares for $30 a share. What loss does Kim recognize, and what is the basis in her remaining 10 shares? Okay, so two questions. What loss does she get to recognize, and then what is her basis? All right, so I'm going to move the verbiage of the problem over here, and then we'll work it out. All right, so let's take a look at the nuts and bolts of this. And so, okay, so first, she's got 10 shares at $40 a share, and so her original basis is $400. Okay, and this is that's originally. Okay, and then what happens on December 5th? She buys 10 more at 30, and so that's $300. Okay, basis. Okay, on December 31st, all right, so this is originally, all right, on December 31st, all right, she sells original shares, all right, and so she receives $30 a share, so she receives $300. Her basis was $400, so there's a loss of $100. All right, but remember, so the question is, how much loss can she recognize? Okay, well, her loss, the $100 loss, is disallowed because of the wash sale rules, okay? Because she bought stock on December 5th, all right, and then sold within that 30 days, okay, the same or substantially similar stock, okay, at a loss. So she cannot take that loss. But what happens to that loss is kind of cool. So the loss is disallowed, but really it's deferred, and because it's deferred because what is the basis in her remaining shares? Well, starting basis in December 5th shares was $300. We add the disallowed loss to that basis. Okay, so now the basis in the December 5th shares is $400. Okay, so what did that do? That essentially deferred the loss, because now when she sells those shares outside of the wash sale rule window, she gets the use of that loss. That loss increased her basis, so it's going to reduce her gain or potentially increase her loss down the road. So the loss is not gone forever. It's really deferred. All right, those are the wash sale rules. All right, so let's talk about some planning strategies. Okay, obviously, if you hold your capital assets for more than a year, right, you're going to be taxed at a preferential rate. Okay, loss harvesting. Okay, you get to deduct $3,000 AGI, right, for AGI. So you can offset capital gains with losses. So you can sell strategically. Okay, and then you always have to remember that you've got to balance tax and non-tax factors. There are periods of time, 2008 is a great example, when you don't necessarily have as much ability to plan your strategy, because sometimes the market does things that are unplanned. So you do have to be careful about that. All right. So this is the last slide in part one, and this is something we need to talk about. So investment interest expense. Okay. So expenses other than interest incurred to generate income are not deductible. All right, so that's very, very important. Your advisor fees, those things, not deductible. Now, if you have trading fees, those are just added to the basis of your stock or your bond or your fund. Okay. Investment interest expense. We've talked about this already. This is interest expense on loans that you use to acquire investments. Okay. It is deductible, but it's a from AGI deduction. All right. And it's limited to the amount of your investment income. Now, anything that's disallowed in the current year is then carried over. So disallowed amounts from current year are carried forward indefinitely until you have income to offset them. All right, so that is the end of part one. Look for part two as well.